We always have the issue, and central banks generally always have the issue of looking at price increases and asking whether they're really threatening inflation. By inflation, we mean year after year after year, prices go up. And if something is a one-time price increase, then you don't react to it with monetary policy because, frankly, the way monetary policy works would be by slowing down the economy, slowing down the recovery, and therefore reducing inflationary pressure. So you wouldn't react to something that is likely to go away. So we have to look at this current situation where we have a number of categories of goods and services where inflation's moving up, as I mentioned, higher than we expected and a little bit more persistent than we had expected and hoped. But we look at them and we look at the story, and the story with you mentioned around used cars and new cars and rental cars it's all kind of the same story. There's a shortage of semiconductors. There's also very high demand for various reasons. People are using less public transportation. They have money because they haven't been able to spend. It's just a perfect storm of high demand and low supply. And it should pass unless we think there's going to be a multi-year, many-year shortage of used cars in the United States. We should look at this as temporary. And we very much think that it is. And so do all the forecasters I've seen think that these price increases for used cars and new cars they'll top out. And then in all likelihood, at some point in the future, and we can't say exactly when, they'll decline because the play will come back.
And do you think, rather than, I appreciate that, those recommendations and what your actions are, is this a time when you see this kinds of transitory inflation of a need for greater public or private investment?
I think there's what investment does is it raises the potential growth rate of the country and makes workers more productive and companies more productive and countries more productive. And that raises living standards. And so more of it is generally better. As long as it's money well invested, then it's worth looking seriously at any time.
I agree. And I would not call any of the things that we're trying to do irresponsible spending. I think you have demonstrated, and the economy is demonstrating, that our investment has been responsible spending to the growth of our economy, to the growth of working class families. I want to pivot to another thing that I care very much about. This is credit rating agencies. Last session, in a bipartisan way, I had the opportunity to work with Chairwoman Waters, Representative Barr, to introduce H.R. 6934, which requires the Fed to treat all nationally recognized statistical rating agencies, NRSROs, uniformly so that more creditworthy companies could have access to the emergency lending. I knew I would run out of time. I don't know if you'd be able to speak to the NRSRO's expansion.
Just briefly, I guess, at the very beginning of the crisis, we really had to get these facilities up and running, and we just kind of worked with the big three. We then consistently expanded over and over again, expanded the group of agencies that we work with. As you know, be happy to talk about this more offline if you'd like.
Shepard Smith here. Thanks for watching CNBC on YouTube.